Is the U.S. housing market on the cusp of a significant correction? Hey guys, my name is Rod Moser. I'm a broker owner of NextHome Navigator here in Salt Lake City, Utah. And this is a question my wife and I and several of my colleagues have been pondering for a little while. I wanted to take a minute and look at some data points. Let's see what Wall Street has to say. Let's take a look at a few key components of statistics that we track regularly, and let's see what's going to happen. All right, guys, let's jump into it. A lot of you who have followed me for a long time know that I'm kind of a numbers junkie. I've been following statistics and seeing how they impact things for years. And one of the things that has concerned me recently is the affordability of housing. I've said it. We don't have a demand problem. Everybody wants to own a home. It's a security piece, it's a place for our families. Everybody wants to own a home. The problem in today's world is and has been affordability since interest rates have gone up. Rates were so low for such a long period of time that it caused an unbalanced appreciation in the housing market. Property values skyrocketed because everybody was buying as much real estate as they possibly could. In fact, the numbers show that about 1 out of every 4 homes that were purchased over the last several years were purchased by investors, not owner occupants. And so we've seen that a lot of people with a lot of excess money have been buying real estate in record numbers. We've noticed that that has started to slow down. Let's take a look. This is a Wall Street Journal report. Came out today, January 16th, 2025. It was written by Carol Ryan. Wall Street thinks U.S. homes are overpriced. And they're saying anywhere from 10 to 35% based on how investors are acting. So let's take a look really quickly at where they're getting their data. So the first thing is the stock market is pricing portfolios of American homes at a hefty discount to what houses are changing hands for in the open market. As a matter of fact, shares of single-family landlords, Invitation Homes, American Homes for Rent, are trading at 35% and 20% discounts to their net asset values, respectively. That gap has widened by 10 percentage points in the past year. Put another way, while the average house in the metro areas where Invitation Homes owns its property sells for $415,000 based on Green Street's analysis of market values, the company's share price implies that investors think $310,000 is more appropriate. Now, guys, that's pretty significant. They go on to say that there's a large and persistent gap that opened up. This started about the time that interest rates started to go up, and investors that are buying this stock started to pay a significantly lower share price based on the asset values. And this is kind of what they're saying. As the existing housing stock is so unaffordable, investors need to find other ways to grow their portfolios. Large players like American Homes for Rent are building houses themselves or buying newly constructed units directly from the builders. They basically said that there's a 4% cap rate, and most investors are looking for a 5 to 6% cap rate. So the profitability of buying these properties has shrunk and made them less attractive to investors. Competition from deep-pocketed Wall Street buyers is the last thing pinched house hunters need at the moment, but it's worth asking what it would take to tempt the smart money back. Without further reduction to borrowing costs or a big uptick in rents, a 10 to 15% decline in U.S. home prices would be needed to turn big investors' heads. That might be a good indicator of how much home buyers are overpaying in today's market. All right, so they're saying 10 to 15%. To give you guys numbers here in Utah, the median home price is somewhere around $600,000, $550,000 to $600,000. That means that they're expecting, at least Wall Street, people with money believe that we're $55,000 to $60,000 overpriced from where property values should be valued based on today's economy. Now, I've always said this: people with money tend to be more accurate in their estimations than people without money. Why? Because people with money can actually create the markets. Morgan Stanley last year came out and said they expected interest rates to be around 6.5% at the end of 2024 and around 6.25% at the end of 2025. Guess where rates were at the end of 2024? Yeah, 6.5%. Again, people with money are better at predicting. So let's take a look really quickly at some local statistics. We know that the value of anything is always going to be based on supply and demand. So what's going on with supply in the major Utah counties in northern Utah? Well, Davis County is actually down year over year 2% in its supply of homes. That's fantastic news. Tooele County is up 3%. Salt Lake County is up 9%. Weber County is up 19% in inventory. Utah County is up 23% in inventory. And Cache County is up 33% in inventory year over year. Those are pretty significant increases in the supply of homes. Guys, everything that we're seeing from inflation that has raised the cost of everything from groceries, gas, everything that people need to survive has pinched budgets. Incomes have not gone up. Home prices have gone up. All of the costs that you associate with survival have gone up, but your wages haven't, which is pinching your budgets. And people are having to pick up second and third jobs to be able to afford homes at today's prices. All of this is a really good indication, guys, that we are overvalued. And in my opinion, on the cusp of a pretty significant correction in the housing market. Why is this important? Well, as I'm talking to, a lot of people that are getting ready to sell their homes or thinking about selling their homes, I can't tell you what percentage, but it's significant of people that say, hey, I'm going to wait until the spring market. I'm going to wait for a couple of months to see how things change. Well, based on everything that we're seeing, guys, in a depreciating market, when supplies continue to go up and the demand is either flat or going down, which it is today, we have fewer investors buying properties. We have fewer people that can qualify. I read something the other day where they felt like we've lost about 68% of the buyer pool due to affordability. So, people are not able to buy the same prices of homes. Back in 2008, 2009, the Great Recession, we lost 75% of our buyer pool because what the subprime mortgage market went away. So all of these people were getting subprime loans. And when that was no longer available and you actually had to prove your income and you had to have a better credit score, we lost 3 out of 4 buyers. What did that create? Well, that created a massive correction in housing prices for a significant period of time. Today, if we're losing 68% of our buyer pool because of affordability, what kind of an impact is that going to have on the housing market? Well, according to this article and according to the people with money, they're expecting a 10 to 15% correction, and I think that's very reasonable. So if you are thinking about selling your home in a depreciating market, the guy who sells his home last loses the most money. So if you are selling your home today or thinking about selling your home in the near future, the longer you delay that decision, the more money that could likely cost you. One more thing I wanted to touch on before I end this is rents. So interestingly enough, we've had a huge number of homeowners become landlords over the last few years. And the reason why is they're locked into a really great interest rate, anywhere from 2.5% to maybe 4% on their current home. It's such a great rate that selling it didn't make sense to them, because if they sold it and then purchased something at a higher rate or whatever, their cash flow disappears. But they're in such a good equity position, they're in such a good financial position on their current homes that they've chosen to rent. What is that doing to rents? Well, we have literally flooded the rental market with homes. There is a ton of available properties for rent in Utah, which is causing rent rates to actually go down. So if you're thinking about, becoming a landlord because you've got a really great financial position, if property values corrected, on a $600,000 home by $60,000, and your rents were getting pinched, does that still make sense? I think that's a question you'll have to answer for yourself, but I'd love to hear your thoughts on this, guys. I know this is a ridiculously unpopular opinion among real estate professionals, right? Everybody's always positive. They think property values are always going up. They think it's always a great time to buy. My opinion is that we are poised for a correction, and we're going to see some significant reductions in prices in the housing market in the near future. Would love to hear your thoughts and opinions on this, guys. Feel free to load the comments. We'll look forward to hearing from you. Thanks so much.